Our next guest says the job market seems to be perking up, but is doing so gradually. Stanley is chief economist at Pierpont Securities and a Bloomberg best economic forecaster. He joins us now from Stamford, Connecticut. Stephen, welcome back to Bloomberg's Bottom Line. Always good to have you on.
My pleasure. Thanks, Mark.
As I just mentioned to our economics editor, Michael McKee, in his remarks today, Chairman Bernanke said the U.S. needs to see faster job growth for a sufficient time before policymakers can be assured that the recovery's taken hold. What is a sufficient period of time?
Well, clearly the Fed would like to see at least, I would say, at least 3 or 4 months of really nice job gains. I mean, we've had decent job gains over the last 3 to 6 months, but not enough to really bite into the unemployment rate. They'd like to see 200, 250, maybe even 300,000 a month type payroll gains, and I think they'd like to see it for, at least 2-3 months in a row before they get too excited.
Should the Fed be more concerned with the rise in food and energy prices? Mr. Bernanke did say, quote, overall inflation remains quite low.
Well, I mean, my personal answer to that would be yes. I think not only does the Fed need to be more worried about food and energy, but, I think they're very sanguine about the core index, and they believe that the core inflation index, which is the one that they follow most closely, is going to stay very low for a very long period of time. And history suggests that they shouldn't be quite so relaxed about that. Certainly the last episode, the 2003-2004 episode, which isn't very long ago, it's the last cycle, gives us a lot of indication that core inflation can turn a lot faster than I think the Fed expects it to do so this time.
Stephen, Chairman Bernanke also defended the Fed's second round of quantitative easing, and he said, quoting here, a wide range of market indicators supports the view that the Federal Reserve securities purchases have been effective at easing financial conditions. If it's been so effective, why does the chairman keep defending it?
Well, he has to. I've been an outspoken critic of QE2, and certainly haven't been the only one. And I think that's an important point. The Fed took a lot of heat, Bernanke personally, but also the Fed as an institution when they did QE2. And I think you've seen kind of circling of the wagons. Even some of the hawks who weren't in favor of QE2 have softened the rhetoric. And there's been a concerted effort to defend the Fed, and I think Bernanke obviously has to be at the vanguard of that. So he could never come out and say, well, gee, we did QE2, but it was a mistake, and now we need to reverse it. I think they're kind of stuck with the position, and they're going to have to ride it out.
And it's interesting because Michael McKee also telling us that in that radio interview with our Kathleen Hayes, the Dallas Fed president, Mr. Fisher, saying that if there's a QE3, he's not going to support that.
Right. Well, both President Fisher and President Plosser, coming into the year, they rotated into the voting, into a voting role, and there was a lot of speculation that they might dissent. And both of them in speeches in early January suggested, well, we're not all that eager to dissent. There's not much point in it because the majority will be in favor. But what we do want to do is draw a line in the sand and say, okay, we'll go through June, but that's it. And both of them have kind of suggested that. This was a little bit more explicit than what we'd heard before, but it's not really a surprise.
Stephen, we should point out you correctly forecast the number of jobless claims. They decreased by 42,000 to 415,000 in the week ended January 29th. Is part of the reason because companies are holding on to more workers as sales improve?
Well, I definitely think we are seeing an improvement in the labor market. The weekly jobless claims numbers have a lot of noise in them, especially this time of the year and especially with all the weather that we've had over the course of January. So, I wouldn't make too much of 1 week's move in initial claims, but I think in general you have seen a downward trend in that number for pretty much 6 months now. And it jives with a lot of the other indicators that we're seeing for the labor market, which suggests that firms are starting to get more interested in hiring people. I think they're starting to get more comfortable with the idea that this is going to be a sustained recovery.
And Stephen, what are you expecting from tomorrow's employment report?
Well, I think we'll see a payroll gain of about 150,000, and I'm including about a 20 to 30,000 downward impetus from the weather in that. So it would have been a little better if the weather had been more normal. Private payrolls up 170. Still not quite what the Fed is hoping to see, I think, over the long run, but we're certainly getting there. And I think over the next 2 or 3 months we will. We've traditionally seen payrolls break out to the upside mostly in the spring. So I'm looking more, March, April, May, that time frame for some big numbers.
Stephen, could I ask in our last 20 seconds, the situation in Egypt and the risk that unrest might spread, does that change your outlook for emerging markets?
Not at this point. I mean, it's obviously something to keep a close eye on, but you know, I certainly don't think it will have a big impact on the U.S. economy. It's something that we'll have to watch, though, because it's obviously a very fluid situation.
Stephen Stanley, Chief Economist, Pierpont Securities, joining us from Stamford, Connecticut. Stephen, always good to have you on. Thanks so much.
My pleasure.